Welcome back to the Jumpify Labs Podcast, the show for founders who want growth without the guesswork. Here we talk about the systems driving predictable growth, and most founders think their business will be valuable when that time comes. But today's guest sees what actually happens when that time finally does, and why most owners could potentially leave a lot of money on the table. He helps founders understand what business buyers are really wanting to pay for and how early that work actually needs to start. Fred Kaplan, welcome to the show.
Thanks so much, Jay. It's good to be here.
The pleasure's all mine, Fred. Okay, let's talk a little about exit planning. How did you get into this space in the first place?
Well, I was working in a CPA firm, and I would have clients that would reach a point where they wanted to sell their business, and I would refer them to Stony Hill Advisors. I knew the founder and CEO through business networking, and they did a great job for my clients. So in 2020, May, I left the accounting firm and I joined Stony Hill full time. So I'm about to hit my 6-year anniversary of brokering deals, not just consulting on deals.
Okay, and what patterns are you normally seeing when founders first come to you for valuation? Because you are looking at the numbers, you have a CPA background. What are some of the patterns you're seeing when that first interaction starts?
Sure. Well, it somewhat depends on where that business owner is in the trajectory of their life cycle. Many times I get a call that's, "Hey, Fred, I've been thinking about this for 3 years, but I'm now ready to sell my business. Let's go to market. How soon can we get this closed? And can we get to my number?" And unfortunately, many of those businesses are really not ready to sell at that moment. They're not ready, and they're not as attractive as they could be. So I prefer to meet business owners earlier in that when they're in their own head thinking about selling. Our firm has sort of adopted a platform we call selling your business is a 1,000-day journey, meaning about 3 years. If you can think that far ahead and plan that far ahead, we can really help you make your business ready, polish it to be as attractive as it could be, and therefore earn the higher valuation and higher transaction value.
Could you share some of the things that every type of buyer, especially if you have a book of buyers, the aggregators have one thing they're looking for. Maybe a retirement couple that wants to just have a little something on the side, they're looking for something different. In general, though, what makes a business a lot more valuable to the general buyer?
Sure. And some of that depends on who the buyer is. So, for example, an entrepreneurial buyer is generally buying future cash flows. They're making an investment, but they want to operate this business. So they're focused on what we call normalized EBITDA. So in a financial statement, you start with your sales, less your cost of sales brings you to gross profit. Then you subtract your selling, general, and administrative expenses, which brings you to net income. Then you add back interest, taxes, depreciation, amortization to get to EBITDA. And then we go one step further, especially in the lower middle market, to a metric called normalized EBITDA. And this is where we add back maybe the owner has a lot of perks that a buyer would not incur. And so we're looking at approximating the free cash flow that is generated by this business from its operations. And that's what an entrepreneurial buyer is looking for. A strategic buyer, let's say a competitor in market, out of market, or a company that's similar that's out of market, may not be looking for EBITDA as much because they already have an infrastructure. They have a marketing department and human resources. So they're really looking at incremental gross profit that they can add to their organization by buying this particular business. And then you have the institutional buyer, like a private equity, that may be focused more on sales because they started with an initial platform business that they bought of 15 million revenue, and they want to get to 75 million before they flip it to another private equity firm. So they're more focused on growth, let's say, than even profitability. So it's a long way to answer your question that the needs of the buyers are different based on kind of where they fit into the ecosystem.
Personal question for you, which of those types of buyers do you like working with the most?
Oh, they all have their pros and cons. I like working with the entrepreneurs because at the end of a deal, they're acquiring a business, they're excited about it. There's sort of that personal attachment, and representing sellers, they're getting a pot of money, and so they're happy too. So it's nice to be able to broker a deal where both parties are happy. On the strategic side, they're building a business, and on the institutional side, it's more of a business transaction than a deal of personalities. So they each have their pros and cons, that's for sure.
Hmm. Yeah. Okay. And what's maybe a common mistake? Now you've put these different businesses to three different types of buckets for the three different types of buyers. But as a seller, what's a common mistake that kills a valuation before
Sure.
the sale?
Yeah. So I'll say that sellers often have an inflated perspective of their own business value because they're tied to it emotionally, right? No parent thinks they have an ugly baby, but some babies are cuter than other babies, right? And so
That's funny.
for a buyer, it's hard when I have to have the conversation that your business is not. I'm sorry, for a seller, your business is not worth what you think it is from a buyer's perspective, because a buyer is going to look at risk factors such as too much owner dependence. If you are your business, how do you sell it? And that's why historically only between 20 and 30% of businesses that are brought to market actually sell. So 75, 80% just close because they're not sellable. So that's an important part of the coaching. And that's why we talk about this sort of 1,000-day journey. If I'm leading Kaplan consulting firm and my clients hire our business because they love me, how do I exit and let them have an ongoing business? That's very hard. I have to train people. I have to turn services into products and create an enterprise that will outlive me. And that's not something you can do, in a couple months. So that's a risk that many founder-led businesses have that buyers see. Also, customer concentration. I see many businesses where I'm dealing with one now. Their top 10 customers represent 75% of all sales. So to a buyer, that's a risk. Sure, the seller has great relationships with these customers and has no fear that the customers are going to leave him. But the buyer has real concerns because the buyer does not have the same relationship. What if the relationships are even terrific and that customer gets bought and now they no longer need these services? So those are two of the big risks that buyers see that I find that sellers don't put enough emphasis on fixing prior to going to market to sell the business.
When you're dealing with sellers that have this inflated valuation in their minds, one thing we always kind of struggled with, well, maybe not really struggled with, it was just one of those tense moments where it's a come to Jesus conversation where you tell them like, hey, your business is not worth multi-millions of dollars, it's worth this. What are some of the things that you do to, I guess, grease the skids in order for them to accept that or openness instead of just immediately being defensive?
A part of the message I try to share is that a buyer who's interested in your business is likely looking at others also. So you have your own intrinsic value, your profit margin, your amount of revenue, right? But if I could find another business that for the same revenue is far more profitable, that might be a more desirable company for me to acquire, and it pushes you sort of down in the comparison. So some of the issues are intrinsic to the business and others are related to the market and what else is available. I have a client right now, it's a 12 million revenue business, but because of what they do, they earn their revenue through commissions. So their margins are never more than 20 or 22% gross margin because that's the amount of commission they get for the work that they do. And that means after subtracting their selling, general, and administrative expenses, their net margins are somewhere between 5 and 10%. Well, if I'm going to invest $3-4 million, I could invest it in the stock market and over 10 years feel pretty comfortable I could end up with a compounded annual return of close to 10% without the risk of running a business. So why would I buy a business that is less profitable than just a basket of mutual funds and much more risk. It's not an attractive business. It's great for the people that operate it. It provides them with a nice income, but it's not as attractive as other businesses out there for a buyer.
Very well said. Yeah, very strong point. Fred, so we're kind of on the in the scope of the conversation where we're kind of bringing down the valuation, something that we want to avoid, of course. But can you also share an example where the preparation significantly increased the valuation?
Sure. One area, certainly in small businesses, is the lack of quality financial statements. A buyer can look at the business and look at the products you sell or the services you provide and think this would be a good business to run. But if they can't see quality financial statements, they really can't verify that assessment. And I see many businesses that don't put enough emphasis on quality financial statements in accordance with U.S. generally accepted accounting principles, accrual-based statements. So we have to go through a conversion process before we market the business to put them financial statements into a format that is consistent with U.S. GAAP, and that way it's easier for buyers to compare your company with other companies. So that's a big issue. Unfortunately, that reduces value for many companies once this kind of conversion is done. Again, in this sort of 3-year prep, we look at what's your customer concentration and how can we reduce that, which is kind of intellectually backwards in that many consultants will say, if you have a good customer, grab as much of that wallet as you can, sell them more products, more services. The challenge, though, is that creates more customer concentration. You're more beholden to that one customer. My advice as you're approaching a future sale would be to sell. It's better to find new customers than sell more to that same customer. So we try to kind of change course of the battleship a little bit, and it takes time. It's not fast.
Right. Yeah. Very interesting. Fred, so that, yes, definitely some kind of way to upsell their customers and extract more lifetime value from the current customer base. Absolutely. Systems, though, also are something that I'm sure a lot of buyers want to see systems in place so they don't have to go in there and build it themselves. But what kind of systems in place need to be there that maybe founders don't expect that buyers are actually looking for?
Sure. Well, I'll go back to accounting systems and financial reporting. I say would be the core system that needs to be in good order. Can you close your books promptly? I have a client now, and we're in February, and they haven't closed the year end yet because they don't have a good system for that for financial reporting. And buyers like that. It gives them confidence that if that's part of the business is run well, the rest of the business is run well. Human resource management, that your payroll system, your compensation structure, your benefit structure is all very clear, and you pay and reward people well for performance. So that's kind of an internal structure. We call this elements of structural capital in a business. Intellectual property, we want to make sure that if you have research and development costs, they are appropriately capitalized or expensed. That will change your financial picture. And it also relates to what is the buyer buying, because intellectual property can be a significant element of value of this total enterprise that you're buying. So they want to make sure that's all buttoned up with patents, copyrights, whatever it may be. And sometimes I find that founder-led businesses are a little too casual in those areas. And so they're not attracting that strategic business acquirer who recognizes I'm going to have to invest a lot of money to sort of clean up all the debris on the deck.
Yeah, very, very interesting. Okay, Fred, let's pivot a little bit towards your own practice. As your advisory grows, what part of it has been the toughest to scale?
Sure. So I'll backtrack. We've been in business for 15 years and initially started by brokering sales. So we sell small businesses to large businesses and to entrepreneurs. We also source acquisitions because one of the fastest ways to raise the value of your business is acquiring another one. So you're adding revenue, you're adding earnings to what you already have. We do business valuations. It's part of selling a business because we need to know that hurdle rate, what offers to accept or to decline. So we need to have an understanding if we're representing the seller on what we're worth. Now, that doesn't mean that's going to be the size of the offer, because to a strategic buyer, the business may be worth more than just its financial position, because it has products that fit into the mix that maybe take the buyer's product offering and kind of makes it whole, or provides diversification, or provides other value. And so it's selling businesses, sourcing acquisitions, valuations, and then what we call end game value planning, which is a type of exit planning that really focuses on raising the value of the business for that future sale, whether it's 2, 5, 10 years in the future. One of the challenges I find is that like I said earlier, many founder owners I find are not planners by nature. They're more sort of the ready, shoot, and then aim kind of leader. And so exit planning is not in their mindset. And so they end up selling for less than really what they could have.
Yeah, that's unfortunate, because this is a process, as you and your firm put it, journey of 1,000 days. And yeah, something like this, preparing the books, getting all these things in place, systems one, and then of course making things attractive for a buyer. Those things take time. Okay, well, Fred, if somebody's listening to this and they're saying to themselves, oh, I probably should have a conversation with Fred, where can they go?
Sure. Yeah, we'll have a conversation with anybody at no fee, just to scope it out and see if we're the right fit to help them. And if not, we'll refer them to somebody else who is. We have a big network of supporters for whatever those needs are. My email is fred@stonyhilladvisors.com. That's STONYHILLADVISORS.com. My office phone is 215-801. You can find my profile and contact information on our website, which is stonyhilladvisors.com. And we have tombstones of completed deals. We have videos of educational webinars that we've delivered in the past. So we're easy to find.
All right. Well, Fred, thank you so much for sharing your experience and your knowledge with us. And if you're listening to this and you're thinking about possibly exiting or possibly buying, or just wanting to have a conversation for a future exit or a future purchase, be sure to reach out to Fred for more. And if you want to hear from other leaders, other people that are pushing the envelope for business growth, be sure to tune into the Jumpify Labs podcast. We're bringing on leaders every single week, and we're sharing the knowledge freely for you on this podcast. My name is Jay. Thanks so much. Take care.
Thanks, Jay. Good to see you. Take care, everybody.